Hey there, welcome to the channel. So today I want to take a little bit of time to talk about the real lessons we need to learn from this FTX debacle. All right, so by now you've all heard about FTX and what's going on with this implosion of the FTX crypto exchange. And there's now it's devolved into a situation where it appears that there's a lot of fraud going on or was going on in the company. There's apparently missing customer funds, loans, or transfers of money back and forth between all these different entities. It's a very big mess, and it really looks like it very well probably was just another kind of a Ponzi scheme. But I think there's more to this that is more general about what's going on in the crypto space. And I think that we need to learn a much more important lesson that we can apply to all of our investing anytime we're looking at making an investment, as to like how does this work. So if I go even now to this day, I can go to Binance and I can go to their staking page and they're claiming that, hey, grow your crypto and earn up to 13.5% APY. How can you do that? When interest rates on the 10-year, like 4% right now, and that's after rapid rates by the Fed, um, how can they offer you nearly twice that? How can they do that? And they have these different offers for different amounts, flow. I don't know what flow is, FTM, ETH, Matic. And this one over here, BNB, that appears to be the Binance, their own coin. They'll give you 3.5% on that guy. So the real question is, what's going on here? How can they make this offer to give you this huge, significant return on your money? How can they do that? Well, there's a couple things. If we look at this, how could they do that? First of all, most likely there has to be some form of leverage, right? To get high interest rates, you have to take high risk, and therefore you also normally have to leverage. And both these things together equate to high risk. So when they take your crypto and you stake it, they have to go out there and do something. They have to leverage it up. So if you give them 100 coins of whatever, they're going to have to find a way to leverage that up 10 times or more, and then loan it to someone or send it to someone so that they can make money on that to pay you the 13% that they're promising you, or the 10% they're promising you. So they have to leverage it up. And the point as well is that with it comes risk, that with that comes risk, period, in the report. So that's the thing that you need to keep in mind. So it's not risk free anytime. So now it's a general rule. Anytime you're talking about high interest rates, earning a high rate of return, you have to take risk to do that. And the rule is that generally the higher the interest rate, the higher the risk that you have to take to earn that rate. Now, this is a great reference. Right here is the 10-year yield, 10-year treasury. This is what many business people use as the risk-free rate. And it's a pretty risk-free rate. Okay. And what that means is you need to compare every investment you're making relative to the rate you can earn on a 10-year treasury. So right now, this thing is we're just going to round it to 4%. This is in basis points or whatever, but it's 4%. That's what you can get. So now that's the easiest way. In other words, someone could pay you 4% on anything at no risk, right? That's kind of your bottom line right now. And the reason for that is because they could take your money and just put it in treasury and give you the money that they get from the government. There's no risk of default, et cetera, et cetera. You're always going to get that money back. No risk of loss. Anything to earn more than that, then they have to take some risk. They have to go put the money to work somewhere and get you that return. And that's what as people investing things, we need to kind of keep in mind and we need to be aware of. So over here, for them to give you twice that 13.5% or whatever. See, it's interesting. Some of these are actually kind of interesting because this rose like at 4%. Well, you'd be better off doing a treasury. BNB 3.5%. You're better off doing a treasury, right? Now, there's a couple other things here. One of the issues is, and I'm sure it's in the fine print, but like what a lot of these companies have done is they'll pay you in their own crypto. So we have Binance, they have the Binance coin, and I assume that they're not going to pay you in dollars because that's like real money. So they're going to pay you in their own coin. But it's also a very risky thing. So if we go look at the FTX token, so here's the FTX token. You can see over here that this thing is just, as FTX is imploded, it's gone off a cliff. It's just fallen to nothing. And the reason for that, why is this that happen, is because look, when they're printing it up, they're making up their own coin. And they're not like a government. They're not like a central bank. And they're just basically making up their own coin, printing their own money, and then using that and handing it out to you. So this is a perfect example of how they could pay you 13%. They can give you their own coin. So let's go ahead and look at the Binance coins. We'll just make that assumption for right now. They're going to pay you in Binance coin. Now, right now, it's really interesting because see how it exploded higher and lower? That was all that stuff was when they were talking about potentially buying FTX. And so there's a lot of uncertainty in there. But even now, this coin is looked to be trading at, about 270 US dollars. And this is a coin that my understanding is that they can just print up at any time. So they can pay you in this coin, et cetera, et cetera. That's how they're going to do it. But you need to understand, what is the value of this coin? Who's backing this up? And then how stable are they? So if you look at it, because you have to think at some point, it's like you have dollars. If you have actual dollars, at some point you're going to have to go buy. You're going to have to buy the crypto, and so you're going to have to buy, whatever you're going to do if you buy Bitcoin or whatever, and they're going to pay you back in these BNBs, whatever these things are. But the key part as well is if they get into trouble, have any problem, they're the only ones backing up this coin. You can't go to anyone else to back up this coin, right? So if this thing goes through the floor, you're not going to get your money back because you're going to give them dollars. So you're going to give someone dollars to get Bitcoin or Binance coin or whatever. You're going to go stake it so you don't have access to using it. And then you're going to get return these basically Chuck E. Cheese tokens. Okay. So that's how this works. Now, I don't think that this is done in any way. I don't think, if given the situation that FTX is in and what's coming out there, I mean, and I understand this is speculation, but why would these guys be any different? Why the heck do you think that these guys are any different? That they're not doing the same kind of shenanigans that FTX was doing? I mean, think about it too, is we know they're offering, right? You know that they're offering these kind of high rates of return. Now, yes, they can pay you in the coin that they make up, but that's not the complete picture. They want to take your money and do something with it to make money on it as well. Otherwise, they wouldn't be doing it. So the point is, they have to be levering it up. They have to be taking high risk. And therefore, that's where the issue comes in. If the value of the token goes down for whatever reason, it doesn't even matter what the reason is, it is the collateral. And if that goes down, everything falls apart. So the real lesson that we need to learn from like an investing point of view, with high returns, high interest rates, comes high risk. And the higher the return, so if your return is going up to the right, your risk is also going up. And this is a general rule. And this has not changed through all history, and it will never change. So therefore, you have to manage your risk. So, this is something that this whole crypto generation, unfortunately, is really got sucked up with. This is the tulip bulb, bubble from the 1700s in Holland. It's like it's just a repeat of all the same things. It's the 1920s roaring stock market before the crash. It's the tech bubble. It's all the same things. Nothing's different. You believed that you were in a situation where you could get high returns without any more risk, that it was flat, and it's never flat. It is never the case. So that is the real lesson that we need to learn from this whole FTX thing and this whole crypto situation in general. We need to learn, and we need to remember some real basic investment stuff. Higher interest rates equals higher return. Now, one thing that you can do to help understand that is flip it. Flip the coin. Instead of you investing in something and expecting return, put yourself in the position of the entrepreneur, of the Elon Musks of the world, and you're borrowing that money. You're borrowing $1 billion to build, Tesla or something like that, right? You know, how are you going to return that money? I mean, it's a really interesting thing, because when you understand a little bit about business and stuff, when you borrow that money, you understand that it's really, really hard to return that money. And it's a very important goal. Entrepreneurs, it's a big thing. Probably in the first in the line is like, for responsible entrepreneurs, is like, I got to be able to make the payroll. I borrow the money. They also think about it too. Depending on the situation, you'll have medium companies, non-public companies, that may have an opportunity to take debt on to expand and will not, because they're concerned about it, because they're like, hey, can I make the money? Can I take the money and return and make the payments on that? And what that comes down to is like, how do I pay this interest back? So, thinking about it, if you borrowed $100 from someone and you need to pay them back 1%, okay, that's a lot easier to do, right? It's a lot easier to pay them that extra dollar or 2%. But if it's 10%, now you got to pay them back $110. You got to get that extra $10. And as the higher and higher that rate goes, you can see how much more difficult it can be to make that return to pay back that interest. So that is what we need to remember. Very simple curve, just very, very simple here. You basically have your return and your risk. They are what they would call positively correlated. And this is like really, it's kind of like a law. It's more of like, it's just a general, like, it's just the way it is, and it's the nature of reality that it has to be this way. So it's important to never forget this, and don't get bamboozled by things like crypto, technology, AI, this, that, the other latest thing. Nothing changes that. Nothing changes this risk, return versus risk correlation that you see here. All right. Well, that's it for this one. Bye.